been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
On the air for over a decade, the Get Ready for the Future show now on radio, on podcast, and online. We welcome you in where we help people on this show and in our client meeting rooms discover, protect, and share true financial independence. We are glad to have you along once again. My name is Scott Inman, GenWealth co-founder John Shrewsbury on board as co-host today. You know, I was watching that open, and that's what made me think about how long that GenWealth has been on the air with the Get Ready for the Future show. But it also, on our little open there on our video version, it was a reminder of how long I've been on the air, because I noticed in the video, John, I came and sat down and put my glasses on. I don't really ever take them off anymore. So it's not, they're just permanently on my head. So it's been a while.
One of several things that are indicators like that, Scott. You and me too. I totally understand.
Yeah, but you know, it has been kind of a long run now. I mean, 2007 or 8 was when we went on the air.
Well,
right?
we actually, if you back it up, we were on the air, I believe, in 2006. Okay. January of 2006, maybe 2007. You know, as you get older, things get fuzzier.
Yeah,
and
that's right.
In addition to having to have the glasses, you probably need to look up stuff. But anyway, it's been a long run. And we love what we do here at GenWealth, because this show originally started out as purely an educational show and still is today. We want you to understand what's going on with your money, your finances, because all of that is either a catalyst or a barrier to your true financial independence. And we believe that true financial independence is kind of the holy grail. It is what everyone, I don't know any piece of flesh on this planet that doesn't want to be financially independent. I think that if you are, at least anywhere near adulthood, you're thinking about how is it that I can get financially well, that I don't have to worry about what's going on as far as my basic income is concerned. And that's really what we do here at GenWealth.
Yeah, and when we say we help people discover, protect, and share true financial independence, that's the company's mission statement. And, you know, we don't talk often anymore on the radio about GenWealth, but we do know that if you're listening or watching us, there is an advisor on the team that is ready to talk to you and help. We have physical locations in Arkansas, 5 in Arkansas and 1 in northwestern Louisiana, the Bossier City, Shreveport area. And a team of about, what are we up to, 14 advisors now?
15 advisors and 45 total people. And Scott, you mentioned physical locations. We literally have clients, from the West Coast to the East Coast, all across the country. I won't say in every state, but in a whole lot of states, we've got clients because people move and things of that nature, and people have been actually attracted to us from out of state. And so it is really our mission to help people to get to that spot in their life where they feel really good about where they're at financially. And we come alongside you and work together. If you want to kind of think about the nitty-gritty of this, all of the fuzzy things, all of the confusing things about your personal finances and investing and wills and trust, and if it has anything to do with money and your life, we come alongside you and help you to plan that, help you to navigate around all of the confusion and get some clarity about how you're actually going to achieve true financial independence.
And the great thing about answering questions on the Get Ready for the Future show is we know there's a commonality to it, that every time I read one of these questions, as we're about to dive in and do, I understand that there are many people watching and listening that have that exact same question. We want to make sure you know what to do to get more answers specific to your unique situation. So if anything you hear as we walk through these questions kind of spurs you to want to know more and talk to an advisor, we are very easily connected with. You can send an email to show@getreadyforthefuture.com or just call toll-free 866-653-PLAN. That's 866-653-7526. Question number 1 is from Zara in Fayetteville. And she writes, we've been on a good run for a while now, talking about the market. Is it time for a correction? If so, how should I brace myself financially for a potential downturn? Zara, thanks for the question. For certain, a correction is around the corner. I'm very fond of saying when people have asked recently over the last few years, as this imminent recession has been predicted and now backed off on, they say, is a recession coming? And I tell clients, a recession is always coming. We just don't know when. It is very hard to predict. The same goes for a stock market correction. I think any investor should expect volatility before investing in the stock market, period. It's going to happen. It's going to go up and down, and you can't get locked in on that account value reaching a new height and never giving it up for a short time. So
many people really do get that idea in their head that it's only supposed to go up. It's not ever supposed to go down, and financial advisors are supposed to keep it from going down.
Right.
We don't control the market. Here's what we do know. There are times, even in a bull market, where you're going to have a significant downturn. That is the nature of the market. Get used to it. Get ready for it. It's going to happen. Scott, let's take a look at a chart that we've got here. This is furnished to us by Ned Davis Research and LPL Research. This is a chart that basically tracks the average number of occurrences each year for a pullback. So if you take a look at the chart, if you're listening on radio, I'll describe this. A pullback of at least 5% happens about 3 times a year, 3 to 4 times a year, actually 3.4 if you want to be statistically accurate about it. Now, a correction, that's a pullback. A correction is a market that goes down at least 10%. That usually happens about once a year. Even in really great markets, you have that correction thing that happens and you go down 10%. The problem that I see, Scott, that most people are not aware of those statistics, first of all, and second of all, they think they should react to those statistics. Now, to carry this out a little bit further, a severe market correction of at least 15% usually occurs about every 2 years. And then about every 3 years, there is a bear market of about 20%. Now, that's on average since 1928 all the way through January of 2025. So that's the lay of the land. But here's the real rub, where the rubber meets the road. What do you do about it? Mm-hmm. And there are some things that you can do to shelter yourself to some degree against market volatility. Number one, you can just not be in the market and you don't have to worry about it. But I don't think that's really productive because it does not allow you to grow your money. It does not allow you to hedge against inflation. There's no reason to take risk if you don't need an inflation hedge or anything of that nature, but most all of us do. Most all of us need that inflation hedge, and they need to grow our money toward that ultimate point where we can actually reach financial independence. And you just can't get there from here if you play it safe in most cases.
Yeah, let's talk about real quick about what you mean by inflation hedge. So when you're talking about keeping safe money and not taking any risk, you don't have to put up with the volatility, but your dollar that you put away and save for maybe even for your retirement, right, 20 years down the road is going to be worth about half what it is today.
That's right. You have to have a rate of return that is greater than the inflation rate, and it needs to be greater enough for you to grow that above inflation for you to get an actual real inflation adjusted return on your money. So that's really why you need to be in the market. But Scott, the real key is not what happens in the market, it's what happens between your ears. And that's where a financial advisor really comes into play, where they can do a couple of things. One is be sure that you have the right arrangement of finances in terms of diversification and professional management of your money, that you're not just listening to the guy at the water cooler or some guy that thinks that they know about some hot stock that's on the way, it's going to make you a millionaire. Most of the time, that does not happen. And you really are betting your financial future on that if that's what your strategy or your plan is. So a financial advisor can keep you out of that, but more so, a financial advisor can be sure that your plan is structured so that it will survive a down market and that you will not be liquidating things in a down market when you shouldn't be doing that. And that's really, I think, the key. I've said for a long time on this show, Scott, it is not a bear market that causes people to not reach financial independence. That's just not it. It is a bear market that they react to and do the wrong thing at the wrong time for the wrong reason. And that's where most people get into trouble. How many times have you, and I know I've been in the industry longer than you have, I've seen this time after time, but even you with about 10 years in the industry, tell me how many times you've seen somebody come in and say, yeah, the market went down and I just moved everything to cash and it's there and it's been there ever since.
Yeah, and honestly, John, sometimes they even got it right on the front end. Hey, I felt like it was going to go down, so I got out.
Yep.
But they're still sitting there.
And they never got back in.
And they never were. They have to be right twice when you're trying to time the market, and that's almost impossible.
Well, and they will also say to you, and they're right about this, I didn't lose any money.
Yep.
Well, right. No, you did not lose any money, but what you lost is purchasing power of the money, and you have lost opportunity for the gains that you could have gotten had you gotten back in the market.
So let's get down into the nitty-gritty for Zara. How should I brace myself financially for a potential downturn? I think it depends greatly, Zara, on your age. If you're still younger and you've got decades away from retirement, you should see a potential downturn as a buying opportunity. So if you're putting money in to a 401k or an IRA or another retirement account, keep doing that. Keep doing it systematically on a monthly basis, because you're going to catch a correction somewhere down the road. And when you do, you'll be able to accumulate more shares with that monthly contribution than you would if the price was high. Now, if Zara is right on the cusp of retirement, and we define that as about 5 to 10 years away from your retirement date, your investment strategy needs to change. John, it's a retirement red zone that we talk about all the time, but you have to protect your income in those first 5 to 10 years.
Yeah, your goal is to protect your income and source of income for that 5 to 10 year period of time as you move toward retirement. This is avoiding sequence of return risk. That is a technical term that we use throughout the industry that we work in, because essentially you don't know what kind of sequence you're going to have in terms of returns on the market. So let me explain. We've been through about 3 years of 20+% rate of return. Is there likely a downturn coming soon? It's probably so, because that just doesn't keep going. Trees don't grow all the way to the sky, and neither does the market. And so you've got to think about, okay, what happens here? And if you're in close proximity to retirement, what you want to do is you want to isolate or segregate a certain amount of money, about 5 years worth of income, setting that aside so that you can pull money from that cool reserve fund, that just very safe and secure reserve fund, and not be selling something if the market does go down next year. You want to leave it alone and let it do its thing. That is just the nature of good, solid income planning. And if Zara is close to retirement, I would recommend that. If not, I would just look at this as an opportunity to further accumulate shares in your portfolio of whatever it is you may be investing in. Broad-based market investments. History has shown that if you've bet against the American economy, most of the time you've lost in the long term.
So, as we said at the beginning of the show, that these questions are often applicable to many people watching and listening, I want to offer that invitation. If you are in the retirement red zone, if you're 5 to 10 years out when you think you will retire, are you prepared? Is your portfolio prepared for the next market downturn? Do you have a retirement income plan in place that protects your income in the early years of retirement? If not, I want to invite you to reach out to GenWealth, because our advisors here every day develop plans with those things in mind. So call us at 866-653-PLAN or 866-653-7526 to get started, so that you can secure your true financial independence. Next up on the show, it's Colleen from Little Rock. I'm 52 with $2 million. Should I convert some of my traditional IRA/401k to Roth accounts now? I have 20 plus years before RMDs, that's required minimum distributions. Is this a good window for conversions while managing tax brackets? It certainly could be, Colleen. The most important considerations here for whether to do a Roth conversion, the two things you need to consider are time and taxes, and you've already referenced it, but we want to walk through what that specifically means. It can be a good time to manage tax brackets. Generally, incomes are going to go down somewhat in retirement. Some people do step off into retirement and maintain 100% of their pre-retirement income, but more than likely they won't need that for various reasons because they no longer will be contributing to their 401k. They will have different sources for health insurance. It may go down if they're Medicare age. The expenditures will likely go down. Hopefully your mortgage is going to be paid off. All kinds of reasons that people don't need 100% of current income. They may want it, but generally the stats will tell you that you're not going to spend as much in retirement. You're not going to be taxed on as much because your income is going to be lower in retirement. So often the first years of retirement, John, are a good time to really take a look at potentially converting Roth, but she's still 20 years away from that, so she has time.
Yes, and I think you also have to think about a little bit of a calculus here. Do you have the money set aside in non-qualified assets to pay the tax that's going to be generated from that conversion? Because essentially what you're doing is you're taking pre-tax money and you're paying the tax on it inside your retirement accounts and then converting that to after-tax money so that you have tax-free income from that Roth account. A couple of equations here, Scott. One is, I think if you have a small amount of money that you're wanting to convert and that can get absorbed in your tax refund or in you can handle it without too much problem, that's one thing. If you have $2 million, as is in this case with Colleen, you got to be careful about how much you actually step off and convert because it can create a huge tax bill for you. And a huge tax bill now could be worse than tax-free, are paying those taxes stretched out over a period of time. I know you just worked with a client and did some really roll-up-your-sleeves, hard analysis of whether it was better to convert or not.
Yeah, so this client recently came in a few months ago, and he had retired from his first career and was working in his second career. The first career, he was a pension was available, and he was receiving the pension from his first career. So his income was pension income and also employment income, and he was wanting to take a look at the potential of converting some of his traditional IRA dollars to a Roth IRA now so that he could have tax-free growth in retirement. Now, his retirement timeline was about 5 years away, so a little bit tighter than Colleen's here, but if this applies to you and you're thinking about it and you're 5 years away, what we did was we took a look at where his current income tax bracket was and what we could do to, quote unquote, fill up that tax bracket. In other words, convert enough traditional dollars to Roth without jumping into the next tax bracket. And we took a look at that, saw where that was, and then we projected after we built a retirement income plan and what they had accepted to say, hey, this is what we're going to live on in retirement when the pension is still coming, right? So they're not going to be able to reduce their overall income a whole lot. So they were pretty much in the same tax bracket. They were going to be in the same tax bracket in their retirement years that they are in their pre-retirement years. So if we converted in pre-retirement, the tax that they're going to pay was essentially the same as it was going to be in the future. So they weren't going to save on taxes. So if that was their preference, and that was what it was for them, was if we do it now and pay the taxes now, we won't have to do it later. Tax rates could go up. There's no question about that. But at the time we did that analysis, John, it didn't make sense from the tax perspective. Now, the other piece to that, we love tax-free income. So there is the potential to have that flexibility in retirement that you don't have if you don't make the conversion.
Yeah, tax-free, having a bucket of tax-free income that you can reach over and grab if you have a capital expenditure that you're needing to make in retirement. It's a whole lot easier to pull that out of a Roth and not have to pay any tax on it than it is to pay the tax on it, because you're probably going to have to pull 30% more out of the the pre-tax retirement account than you would out of the Roth. And so there is no pat answer to this. Here's what I know. I know that oftentimes people get railroaded in their mind because there is so much hype and so much talk on the tax bomb and your IRA doesn't belong to you. It belongs half to you and half to the government because they're going to take 50 or 60%. Well, all of that is just a bunch of hype trying to get you to come into their office so that they can sell you something. And it's probably not in your best interest, quite frankly, to do that. Now, I think that the analysis type of thing that Scott just went through with his client does bring clarity. And what you really want is not to walk into a financial advisor's office with this predetermined idea and then try to get it validated by the financial advisor. What you want to do is you want to go in and say, hey, what is in my best interest? And that's exactly what this client asked. What is my best interest? Should I pay taxes now or should I pay taxes in the future on this money? And that type of analysis needs to be carefully done. I know that's not what you necessarily want to hear when you're fearful about taxes, but that's what you need to hear because that's what is really, truly in your best interest.
And John, I didn't give you the end of the story. What we landed on here was because he was going to work another 5 years and they were eligible to make Roth contributions and already had Roth IRAs, we're going to max out his and her Roth IRAs between now and retirement. Go in the front way.
Yep.
And go ahead and build it up that way.
Absolutely.
Yep.
We love tax-free income in retirement if you can get there and not throw the baby out with the bathwater, so to speak.
Yeah. So, Colleen, I don't know where your income lands. Obviously, if you have $2 million in retirement accounts, you've been able to put a significant amount away. I do think that if you are eligible for Roth IRA contributions, or Roth 401k contributions, which can really accelerate the tax-free income because those contribution limits are higher. I would take a look at that as well. Are you doing that? And then, of course, look at the conversion as well. This is the question of the week. So congratulations, Colleen. You're going to get a Get Ready for the Future show tumbler for being named the question of the week. We just need you to claim it by sending an email to us at show@getreadyforthefuture.com. Next, it's Corey from Maumelle. If I start earning self-employment income, what tax-advantaged retirement options become available? How should I handle estimated tax payments? Thanks for the question, Corey. You have to ask yourself first, how much do you want to save for retirement? The planning process is always key here. And if you don't want to or need to save more than $7,000 a year, an IRA is going to be an easy option for you. And you can always, with any earned income, be eligible to contribute to an IRA. And that's not specific to an employer plan. But if you are self-employed, John, there are a lot of options that you can take a look at that are, quite frankly, very easy to set up and be able to divert some of your income into a tax-advantaged retirement account.
Yeah, let's kind of use a term here. If you're a solopreneur, I know there's a lot of people out there listening to this show that you have a business that it's just you, or maybe you and your wife working together. If you are a solopreneur and don't have any employees, then a simplified employee pension or an SEP account is probably a great option for you to consider. It will let you contribute a greater amount of money on a pre-tax basis than the IRA would in most cases. The SEP limits are 25% of an employee's compensation up to $70,000. And that is made through an employer contribution. And so it comes off your taxes. If you're a solopreneur, that's a great thing for you to be able to do. If you have employees, you might want to consider a simple IRA account. Now, you think IRA account, that's not much, but this is actually sort of a scaled down 401k plan. So a simple IRA account works much like the 401k. The benefit, your obligation to your employees is far less than an SEP. In an SEP, if you have employees, then you have to contribute a like percentage of their salary that you do for yours. So if you contribute 15% of your salary to your SEP, you would have to contribute 15% for your employee. That is for the SEP plan. The Simple plan basically reverses that. Simple allows for there to be employee contributions on their own out of their paycheck. And as a business owner, the max that you're obligated to do with a simple contribution is to match 3% dollar for dollar in their contribution. If they don't contribute 3%, you're not obligated to contribute 3%. You're only obligated to contribute the amount that they contribute up to that 3% level. And so we see a lot of simple programs out there. You can contribute an employee can contribute about $16,500 to a simple, and there's a catch-up provision of $3,500 in that window between 50 and 59. And from 60 to 63, the catch-up is $5,250. Mm-hmm. And so simple is a really great way if you have a couple of employees that you can work with to do that. Here's a little bit of a benefit to the employer. Oftentimes, employees don't contribute on their own. Therefore, you're not obligated to contribute anything for them, but you're still allowed to make your contribution into the Simple program.
Yeah, and I like the solo 401k. That's another one that doesn't get utilized very much, too. It's a little more costly than a SEP or a Simple. A SEP can be basically one page that gets one IRS form gets filled out, and then you open an account, and really the cost is only the investments and what's inherent to the running of that account. Now, with the solo 401k, there's some more reporting that has to take place. There's a third-party involvement, so there is an annual fee. There's some costs that go along with that because of those requirements, but there's a contribution limit that allows you to get the same in as if you had a corporate 401k or a 401k through a W-2 job, which is $23,500 for anyone under 50 and a $7,500 catch-up for those 50 and over. And the employer, which of course in this case as a solo 401k owner is you, can contribute up to a maximum of $69,000 in 2024. Now that's an aggregate, I should say. $69,000 is the total amount that can go in. So you had the $23,500, the $7,500 catch-up on the employee side. You can match on the employer side as well. So this is a great opportunity for higher earners to get a lot of money in and do a lot of catch-up. We've got a couple of clients, in fact, that have started this. They've found themselves in a higher income earning job later in life, so they're behind for retirement, but now they have the margin in their life between their income and expenses to really accelerate things. These clients are in their early 50s. They do this for the next 10 years at this kind of level. It's going to make a huge impact.
Absolutely. They ask about estimated taxes. Let's talk about that for a second. And this is simple. Get a CPA. Be sure that you stay on track with your estimated payments. There's penalties and interest for not doing that. You don't want to do that. Every dollar that you send to the IRS, who knows where it goes, and it does all kinds of different things out there that are, can be controversial to people. You certainly don't want to layer on taxes and penalties, so go pay a CPA to help you be sure that you're on track with your estimated tax payments. Here's the key. You have to be within 90% of what you would owe on those estimated tax payments. So they do a look back, and there's some math there. It is complicated, more complicated than we want to go into on the show. Get a CPA to help you out with that.
We've got one more question we're going to fit in before we go. Michelle, via email, what's your opinion on the real estate sector right now? Would it be wise to invest more in real estate investment trust, REITs, or direct property ownership? Well, first up, Michelle, we'll give you the disclaimer. This will be a general discussion about real estate and REITs. It is not an investment recommendation for you or anybody else watching or listening. But the commercial real estate market, John, has been in a bit of a bear market over the last couple of years. We saw it be the flyer. It was the star 2 years ago, 3 years ago in 2022 when stocks and bonds were down, but it has certainly cooled off. But many people think this is a great time to get into commercial real estate because the bottom of this bear market may have been hit already, and we may be starting to tick up.
Well, and just like stocks, everything doesn't always go up.
Right.
But there is patience and there is benefit to patience. And I think we'll see that play out in commercial real estate. Now, let's talk a little bit about this direct property ownership versus a real estate investment trust. Let's explain that. A real estate investment trust is a professionally managed real estate portfolio, meaning that it has lots of different things in it. It may have office buildings. It may have hotels. It may have any kind of commercial real estate. And there's a professional management investment system in play there. Direct owned real estate, unless you've got a huge amount of money, you don't have a whole lot of diversification because real estate's expensive. Even a house these days is going to be, $200,000-$300,000. So when you think about direct ownership of real estate, you have to think about how much risk do I have in something happening to that property, or me having to spend some money on that property, or whatever the case may be, versus something that is professionally managed. Now, do you get all the benefits of professionally managed? Do you get all the benefits of direct owned real estate in a real estate investment trust? Maybe not, because the real estate investment trust managers are going to take a fee for managing that real estate. But what you don't have to endure is the headache and the upkeep of that property and all the paperwork that's necessary and all of that. In a real estate investment trust, it is basically you invest in it like you would invest in a mutual fund or an ETF or whatever, and somebody else handles all of the details, and you benefit from whatever the gains and losses are of that, and any income, any kind of distribution that might come from that real estate investment trust.
Yeah, so you might be able to cash out more easily in a REIT versus the direct property ownership, but both assets or both investments, type of investments, should be considered illiquid. That's a big key compared to the stocks and bonds. But overall, when you think of diversifying your portfolio, a lot of people think a mix of stocks and bonds is diversification. So we love the idea of considering other asset classes if it's appropriate for you. And real estate is on the same level as stocks when it comes to the historical nature of its propensity, John, to outpace inflation.
Yeah, real estate is kind of this hybrid between a stock and a bond in some ways, because if you think about real estate, it does appreciate in value and has historically appreciated in value very well. But it also has the ability to pay what in the industry is called a distribution. You think of it as income, that the profit from that, the rent that is paid by the occupants of that real estate, that flows through the real estate investment trust. And real estate investment trusts are required to distribute 90% of their net income to the investors. So if you think about it that way, it does have a bit of a characteristic of a bond as opposed to a stock, but it also has the appreciation possibility or capability of a stock. So we actually position real estate right in the middle of our ready to retire process array of investments, from bonds to real estate to equities, and basically position it on about a 10-year timeline, because we think that real estate needs that kind of long-term hold for it to properly go through the cycles. And as you said, Scott, we've seen real estate of late go way up, and then there's been a bit of a bear market in real estate of late, where we were down 4, 5, 6, 7%. But again, that's why you invest in it for the long term.
So two final things to talk about here, Michelle. One, because it is so different in investing in stocks or bonds for so many different reasons that we talked about, do not enter into that without the help of an advisor. We'd certainly recommend that with all investments. Get the professional management, professional advice that you need there. And then the other thing I would say to wrap up here, John, is we've had a lot of questions lately in the last few weeks on the Get Ready for the Future show about specific investments or specific sectors of the economy. And I think we need to be clear not to get too laser beam focused on specific types of investments, because we can miss the forest for the trees. And what we're talking about here is planning versus investing. And I'm about to hand off to you with 4 seconds left before I hear the final bell. So I'm going to wait for that.
There it is.
And I'm going to let you dovetail into what I just said and then get into your final thoughts.
Yeah, let's talk about this planning and investing thing, because look, we live in the information age. There is more information at our fingertips right here on this cell phone. I can get almost any piece of information that I want. If information were all that were necessary for you to be financially independent, everyone would be financially independent. But there are other factors in play here. There is your situational factors that you've got to play into this. There is the whole mental game of dealing with your money and your finances and what have you. And that's why a financial advisor is so critical to the equation. A financial advisor will come alongside you and be your partner in your effort to become financially independent. They'll listen to you. They'll understand what your goals and your vision is for your future. They'll understand your needs, wants, and desires. And then from there, the financial advisor can work with you and all the complexity of finance and act basically as a filter on all of that information that might come through your phone or through your computer screen. They can act as a filter to say, look, you want to apply this, you want to throw that out because it really doesn't apply to you.
Here's my final thought. We had a question earlier about a market correction. Is it imminent? We had a little bit of a pullback earlier this week, in fact, when the Trump tariff talk started to occur and get ramped up. We did a piece, as we do every week, a video on the fastest 4 minutes in finance talking about those tariffs. And if you want more information that's market and economic related, please sign up for the fastest 4. Just text the word FAST to 501-381-5228. Again, it's 501-381-5228 to have the fastest 4 delivered to your email inbox every Friday morning. That's all the time we have for this week's Get Ready for the Future show. Thanks to all of our listeners and viewers that sent in questions. If you have one for the show, get it in to us. You can send us a text to 501-381-5228, or you can leave a voicemail. Just call that number and ask a question and maybe hear your voice on next week's show. See you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.